How you doing, Carl? You all right?
Right.
Okay, so I'll give 1 minute more for Graham to join us. We did have problems getting into our own Zoom this morning, so glad you guys have managed it. The joys of Zoom.
Indeed.
Right, Tracy, I think let's press ahead. So, good morning. Welcome to our webinar. And this morning we're going to be covering a couple of the aspects coming out of the autumn 2022 budget. You all know me, and I know you all know Tracy, but you may not have met Ian before. So Ian Hancock is our COO, and we'll be hearing a bit more from Ian a bit later this morning. We're hoping that it'll be a presentation of about 30 minutes, and we'll have time for questions and answers later. If you do have questions, then please make a note or pop them in the chat box and we'll pick them up at the end of our presentation. I think Tracy's going to put everybody on mute before we start. I think that's okay. We're ready to start. Thank you, Tracy. So we're going to be covering a couple of bits out of the autumn budget, and that will include the capital gains tax relief situation, a bit about the inheritance tax thresholds. We're going to look at some tax planning wrappers that we don't normally use but might want to include a bit more going forwards. I want to just cover the aspect of multi-asset funds and particularly how they help with the capital gains tax challenges. And then Ian is going to give us an economic overview for the last section of our presentation. So starting off with the aspect of capital gains tax relief, we all know that this year it's £12,300. That's the relief that we've got. That is going to be reducing from the beginning of the next tax year to £6,000 and from the beginning of the following tax year to £3,000. So quite a dramatic drop in relief there. HMRC think that that's going to result in an additional £275 million worth of revenue to them by the end of 2024-25. But I've got a feeling it's probably going to be more than that because the majority of our clients are going to be affected by this one way or another. So who does it affect? Well, obviously it affects anybody selling assets that are subject to capital gains tax relief, but that would include people with multiple property ownership when they're selling properties. It will include clients who have unit trusts, share portfolios, general investment accounts. It will include people that own property that's held in trust, because don't forget that trusts enjoy 50% of our personal capital gains tax relief. So there's going to be a dramatic drop in relief for trusts. How is this going to impact these people? Well, obviously, if you're disposing of a property, the reduced relief rate is offset against the gain, so there'll be more tax to pay there. Sale of shares or unit trusts with a gain in excess of the relief going to trigger more capital gains tax. And when you think about it, a portfolio of maybe £150,000 to £200,000 in unit trusts or shares with a 4 or 5% return in the year, that return in itself is going to exceed the relief available in the tax year. So that could have a serious impact. It's going to affect our ability to rebalance those parts of the portfolio. It's going to affect the ability to take money out of that part of the portfolio to fund ISAs or pensions. And it's going to obviously affect our ability to take withdrawals from that portion of our portfolio as well, whether that's lump sum withdrawals or regular income. And if we've been expecting to utilise that at a later stage, we're going to perhaps have to think again. So what is rebalancing and why is it so important? I just want to quickly revisit this. Rebalancing is simply comparing where we were in a portfolio to where we are today. So if it was a year ago that we last had a rebalance, or a year ago that we started the investment, it's looking at what we had at the beginning and where we are now and how it has deviated from that original position. So why is it so important? Well, it's important to rebalance the portfolio, which is to sell down part of the portfolio and take that sale proceeds and add it to the asset classes that then bring the risk down. And it's usual for a portfolio to become more risk orientated over time, because it's the equity funds that tend to do better than the lower risk funds. So the rebalancing keeps the portfolio at its intended risk and volatility level. And without it, investment portfolios can become very risky and volatile. And we're certainly seeing quite a few portfolios at the moment. When we're reviewing them, they probably haven't been rebalanced adequately, and the risk profile tends to be a lot higher than our clients' actual attitude to investment risk. So it's very important to factor in the rebalancing on a regular basis. Looking at the inheritance tax side of things, before we go into the frozen thresholds detail, these are some figures that we just put together a few days ago. So HMRC figures released just on the 27th of January showed that the Treasury received £5.3 billion in inheritance tax receipts just from April to the end of December last year, an increase of 700 million over the year before. And you can see what the average inheritance tax bill looks like, and that's obviously on a nationwide basis. So what's happened to the thresholds? Well, they've been frozen to 2028. So just to recap, the nil rate bands that we have are £325,000 worth of standard nil rate band, up to which we can give away free of inheritance tax. And on top of that, we've got 175,000 residence nil rate band, which we qualify for if we're ultimately passing the value of a property to our children. And it's these that are frozen to at least 2028. So just thinking about the next 5 years and what's likely to happen to property prices, to investment portfolio values, I think it's highly likely that we'll be looking at greater sums in 5 years' time. I mean, even if we reflect on the fairly turbulent last 5 years, overall property values and portfolio values are up. So the result of that means that we're going to have potentially increasing inheritance tax burden for our loved ones. Also, with more estates, with more value in them, we're going to potentially start to lose that residence nil rate band. So for estates worth more than £2 million in value, we start to lose that additional 175,000 relief, £1 for every £2 over 2 million. So for a couple with an estate more than 2.7 million in value, they've completely lost their residence nil rate band. So quite significant reduction potentially. So one of the things that we just thrown into this slide is, should I avoid taking more income from my pension? Because our pension pots, if they're sitting in an invested area, like sitting in Transact, for example, they are outside of the inheritance tax calculation. And if there are other assets or other savings that we can take income from, should we be looking at that as an alternative, perhaps? So I just want to touch on what some of the additional tax planning wrappers are, and they will be quite familiar to you maybe. Capital investment bonds, I really feel, are going to play a more significant part for many of our clients going forwards from here, particularly because of the capital gains tax treatment, and we'll come on to them in a bit more detail in a second. Life assurance is another potential wrapper. I've got many clients who, as part of their estate planning, have included life assurance, which is taking surplus income and investing it in a life assurance policy, which would pay out tax-free into trust for loved ones. So it's a way of reducing the accumulation of the value of your estate and investing it in something outside of your estate and that can be passed on tax-free. So it might be something that has greater application going forwards. Pensions, of course. Well, there's a lot in the press about pensions at the moment. Jeremy Hunt perhaps, increasing the lifetime allowance, the amount that can go into a pension pot before triggering a significant tax. Is that going to attract more people back into the working market? I don't know. We'll have to see, but it might be a wrapper that we include more frequently going forwards. And many of you will have heard me talk about charitable trusts in the past. So at Montgomery, we have our own charitable trust set up, and that can receive part of a CGT, capital gains tax heavy portfolio, across into a charitable trust without the investor having to pay the tax. So effectively, the charity benefits from the tax that would have been paid. And if gifting to charity is part of your regular activity, or it's something that you want to do on death through your will, then having your own charitable trust can be very helpful. And don't forget, if we've got 10% of our net estate going to charity, then there's a reduction in inheritance tax on the rest of our estate from 40% to 36%. So just to touch on that capital investment bond. The capital investment bond is a single premium investment, and it comes under life assurance rules, which is why it's got some things that are quite unique to it. So you can invest in all the normal range of funds within a capital investment bond, but switching from one fund to another does not trigger capital gains tax. Usually a capital investment bond is broken down perhaps into 1,000 separate segments. So you can do different things with different parts of the bond. So you could gift, for example, 100 segments to a loved one and start the process of moving that outside of the estate, or wrap it in trust or part of it in trust at a later stage. So again, can be factoring some inheritance tax planning there. You can take up to 5% per annum withdrawal free of tax from a capital investment bond, because the revenue deem that to be a return of your original investment. You can establish a capital investment bond on younger lives if you want to. That's not applicable to everyone, or not preferable to everyone, but some people like to include that. And a great thing is there's no self-assessment reporting in relation to the activity in the bond, which is quite attractive to many people. And it's also worth mentioning that there are onshore and offshore versions of a capital investment bond, and the offshore version with gross roll-up can be particularly attractive to higher rate taxpayers. Just want to touch on these multi-asset funds, which are very much Montgomery's preferred way of recommending investment strategy to our clients. So each multi-asset fund is a complete portfolio on its own. Traditionally, when we're building portfolios, we're picking the best UK fund, the best US fund, the best corporate bond fund, etc., in the appropriate percentages to reflect our clients' attitude to investment risk. But of course, the problem is a month later, 3 months later, or 6 months later, those funds have moved out of kilter, and what was a 5 out of 10 portfolio on the risk scale may have become a 6 or a 7 out of 10. And I think the most extreme we've seen over the last few months is a client with a 3 out of 10 attitude to investment risk, who's actually got a portfolio that's between 9 and 10 out of 10 on the risk scale. So you can see that without proper rebalancing, the risk profile of a portfolio can really deviate from where it should be. So the great thing about these multi-asset funds is that the fund management team can be buying and selling the asset classes and the funds and the shares within the fund on a daily basis to keep that risk to its original intention. So all the multi-asset funds we use are risk targeted, and you don't have to worry, therefore, about the risk profile changing in your portfolio. It also means that the managers can be far more quick to react to what's going on in the markets, which has been particularly useful over the last few months when we've been looking at some turbulence in the markets. They are, of course, very well diversified, because each fund itself has the full range of asset classes in order to give you a 5 out of 10 risk profile, for example. And these funds are available across all of the different tax planning wrappers, from your ISAs and pensions to your capital investment bonds. So that's why at Montgomery we really love them. We choose our funds using our core fund filter system, which you may have heard me talk about before, and Ian will come onto this perhaps in a bit more detail later. This is where we take the universe of funds that we have, which is about 10,000 or so different investment funds, apply the filters that we feel are most important to our clients, and that obviously includes performance, it includes charges, it includes how long the fund's been in existence, etc., in order to whittle that universe of funds down to something that's sensible. And at the moment we've got 70 odd funds, I think. Ian, you'll confirm that later, across our active, passive and our socially responsible panel of funds. So it's from those panels that we are building portfolios for our clients. We feel using the very best multi-asset funds available. So I've talked for long enough now. I'm going to hand over to Ian, who's going to give us a quick overview of what's going to happen in 2023. Over to you, Ian.
Thanks, Katie. Appreciate that. Look, I'm going to canter through the economic outlook, and I'll sort of caveat it with these are the thoughts of the fund management companies that we listen to, that we talk to, and we read their material. And what I've tried to do is to, I suppose, bring it all together in some sort of sense, and in a what I would determine as being a plain English style. So I try not to use any fancy words and stuff that the fund managers say. I'll try and do it in a very simple, straightforward way. So if we go back to last year and what happened last year, in 2022, as we all know, was a very turbulent and difficult year for investors. And obviously it started off on the 24th of February with the war in Ukraine, which is still ongoing. And the immediate impact of that was obviously going to be around fuel and what happened to the price of fuel. We've all seen that. We've all, you know, if we don't have an electric car or a hybrid, then we have, you know, been to the petrol station, and we go to the supermarkets and we buy food, and we can see the impact that that's having on energy. Inflation has been the obvious output of that as well, and it's also driven by the fact that high inflation is, you know, we've not long come out of a COVID pandemic, and there's a stimulus that's generated as a result of some pent-up savings being spent. So we've got high inflation, and you know we're into double-digit inflation at the moment. In fact, if you've seen the news this morning, you would have seen that food inflation in the UK is now running at 16.7%, and our average food bill is going to be £800 more this year unless we make some adjustments. So it feels like mine's going to be a bit more than that, because I don't think we're making the adjustments, but food is definitely costing us a lot more money. The impact of that has been on growth within all of the worldwide economies. Growth has slowed down significantly, and again, you would have seen what the IMF was saying about the UK this morning, that they feel that our level of growth will be the lowest of all the G7 countries, but they've been wrong on that in the past, and so fingers crossed that won't be the case. But slow growth is definitely an impact of last year. And again, let's not also forget last year, you know, it was a very hot year in terms of weather, and especially in Europe. And Europe was hit quite badly with a lot of droughts. And the example I quote there is in Germany, where that impacted quite heavily on their river system and their canal system that they used to transport a lot of their goods around. They couldn't use it. So they were using alternative energy sources, which was driving cost up as well. So and last but not least, it would be remiss not to mention the economic experiment undertaken by Truss and Kwarteng, that we all saw what happened as a consequence of that, and the impact that that had on interest rates. So the mini budget has also had an impact. So 2022 was a difficult year. I think all portfolios, and I speak at a personal level, would have gone down. The magnitude of which they would have gone down would have varied depending upon your risk profile, but everything went down. Equity and bonds went down at the same time, which is incredibly unusual. That doesn't normally happen. It's been the worst period for investors since 2008, the great financial crash that happened, and approximately £30 trillion worth of value was wiped off company shares worldwide. So I know it's not always a great sort of statement to make, but none of us were alone in this. Everybody was impacted in some way, shape, or form. So in terms of the future and what's changed and what does the future look like, the future will be different. The managers are definitely gearing up for it to be different. We won't see those derisory levels of interest rates that we've got used to in the past. Interest rates will go up, they will be higher. There won't be that drive to keep that levels of benign inflation, and we won't see those very low levels of inflation. So inflation will get higher. There won't be such a clamber to inject money into economies through fiscal policy. That will definitely be tuned down, is what the managers are saying. The equity markets are going to move from being driven by growth stocks, which is all of the, what were the FANG stocks, slightly renamed, but your Facebook, Apples, Amazons, Netflix, Googles, Teslas, etc. in that those technology stocks. There'll be a move away from those much more into value stocks, is what the managers seem to be indicating. Interestingly, though, what they're saying out of the last financial crisis, a lot of companies, for example, the likes of Uber and WhatsApp and Tesla, they emerged post 2008. So there is a hope that there will be some more innovation going forward as a consequence of things changing. The big shift as well, the managers are preparing for less globalization and more international unstable countries being around, and we've seen that. Obviously, we've seen it, and it's happening in Ukraine. We're aware of the situation in China and Taiwan. And again, just an interesting stat that I didn't appreciate, that 80% of the world's chips are made out in Taiwan. And those are what drives fridges, cars, computers, iPhones, etc. So if ever that situation blows up, then we've got some real problems in supply side issues with China. But that is a concern. Iran is also a concern, and that's a worry for the world as well. And we've seen also some instability this week again out in the Middle East with the Israeli and Palestinian conflict. So there's an awful lot of stuff going on that managers are concerned with, and they see that being a bigger issue going forward. So the future and the changes will look different. So what is going to be the impact of what they're saying around inflation, growth, etc. And inflation, they seem to be indicating that inflation will settle at a slightly higher level than it was pre-COVID. The stimulus is still driving through the market, so there's still a demand, a pent-up demand being there, and some of the constraints that were, what was termed supply side, i.e., they couldn't get product out of China and out of America. That's now releasing. So they do think inflation will settle at a higher rate than pre-COVID. Interest rates as well, they are definitely indicating that the central bankers want to see slightly higher levels of interest rates, and this is their opportunity that they call to hit the reset button. And the reason they want the higher levels of interest rates is that when economies do start to slow down again, because boom and bust does happen and cycles do come, it gives the central bankers the opportunity to tune down interest rates to improve growth and to stimulate the economies. The range that they seem to be indicating is somewhere between 3 and 6%, quite a wide range, but that's what they seem to be indicating. In the UK, we've been particularly impacted with interest rates, more so certainly than America, and they think the issue in the UK will be people coming off those fixed rate mortgage deals, of which there's hundreds of thousands of those due to expire this current year. And people will obviously then be remortgaging depending upon their loan to values, and the fact that their wages have not grown as much, they will be impacted quite significantly. So there is a particular concern, and our average fixed rate deal in the UK is between 2 and 5 years. If you take America, for example, where this isn't such a significant issue, they regularly have 30-year fixed deals. So quite interesting. So in terms of growth, what do they think this is going to happen with growth? They're pretty convinced or pretty sure that the recession will be shallow. And all the indications are that it will be shallow. It's not, they reckon, going to be like 2008, which is which was obviously driven out of the financial crash. And the concern in 2008 was the impact it had on property wealth within the UK. And if property wealth is being hit and being low, that tends to lead to low economic growth. That isn't the case this time. Yes, they reckon there will be an increase in property prices, a reduction in property prices. And it's only, around about 12% is the worst estimates. And in 2008, for example, property wealth reduced by 20%. So the other thing we've got going in our favour at the moment, although it didn't feel like it just before Christmas, is we've got a mild winter and the weather is relatively mild. That's both here and in Europe. So that's on our side. And I'll come back to the impact of that in a second with some more what I would call good news. The US, which is the biggest market, is a bigger concern around their wage growth. They're much more worried about the growth in people's wages and the impact that is having then on inflation. And they're now sort of, as we all know, they're sort of actively raising interest rates, and the Fed have been, they meet again this week, but the Fed have been looking to choke off demand for new jobs. So they need unemployment to rise. And they need it to rise to a level of between 3.5% and 5% so that they reduce their wage inflation. They're impacted by energy, but not to the same extent that Europe is. So that's why the Americans are driving their interest rates up. This week's a really important week in terms of the fiscal and the monetary landscape, and it could be some big stuff happens this week, so we could be looking at a very different environment next week. And the reason for that is the three major central banks meet this week and will set their interest rate policies or their levels. And on top of that, you've got 143 different companies within the Standard & Poor's in the US market announcing their annual results. So there's a keen interest, and if you read some of the sort of press at the moment, you'll see the interest level around that. And the markets have opened up a little bit lower this morning on the grounds of that obviously is going to be uncertain. So we could see a very different landscape next week. The really sort of encouraging news is, and it is optimism for the spring months ahead. And I think it's mainly driven out of the fact that it has been and projected to be a relatively mild winter, is that natural gas prices are reducing, and the future price for gas, it's what they call near delivery, so it's going to be delivered very shortly, is now moving back to the pre-war level, so pre-Ukraine war. So that's good, and that'll be good for inflation. So that will hopefully keep or lower levels of inflation, and the knock-on effect of that will be good for growth. So they're actually even projecting that in the UK, that wood price cap that we've all become quite used to is now, as we know, currently £2,500. They say if natural gas prices continue to reduce as they are so far, the price cap will actually come under £2,000. So intervention by government won't be needed on that one, they reckon, but that's good news for all of us. And on top of that, there's still a lot of people with pre-COVID piggy banks that they like to spend, that they're going to spend money out of as well. So there is some green shoots definitely coming out for 2023 in springtime. So what are we doing at Montgomery? As Katie alluded to there, we continue to use our core fund filter system to select what we view as the best funds that we can get available. And we have, we start with a universe of 10 to 11,000 funds, and we filter that through and we come down to 76 funds that sit on panels. So saying they're the best funds is, we can all say that they are the best, but they are the best funds that fit the criteria that we have set for our clients. So that's important for us. We hold regular reviews through our investment steering committee, which we've set up. We minute that, we have agendas, we have a terms of reference document for that, and more importantly, we actually have representation sits externally with levels of expertise that we don't possess, that A, guides us, B, keeps us safe, more importantly, ensures the right outcomes for our clients. So we do that. We regularly talk to fund managers. and that's allowed to us as well by being a smaller company with a very small panel. A lot of companies have bigger panels, and they don't have the same level of access to fund managers that we do. So that's really good. We watch videos, we get a lot of material sent, we try and keep abreast. A quote I saw quite recently, in fact I saw it last week, was from George W. Bush, that said, hindsight is not wisdom and second guessing is not strategy. So an interesting statement to be made from Bush, but for us, that's actually core to what we do. We can't just rely on what happened in the past as being that will naturally happen again. So you can't use that as your wisdom or your guidance, and you can't second guess either. That is not a good idea to start second guessing. So we don't second guess what's going to happen. We use methodology, we use approaches, we use guidance so that we do it in a much more scientific way. We're not fund pickers. We don't go out there choosing what we think are the right funds because there's a fad. And we've all seen the impacts of that, and we've all seen what happens when you go down that road. So that's definitely not something we do. We publish our investment beliefs on the website, which is often, I would encourage people to look at those, because that drives what we do in investment. And we openly say we're conservative in our approach. So we're not racy in terms of what we do. So what would we say to investors at this moment in time, with all of this going on and all of that backdrop? What do we say? Tune out as much of the noise as you can. There's a huge amount of noise going on. We hear it all day, coming through the BBC, Sky, all the websites, Bloomberg, the papers, it's there. Try and tune it out. Try and stay focused on what your financial plan is and what your objectives are. So what does your plan look like? What are your objectives? So try and stay true to that rather than worrying. Try not to look at your portfolio every day. It's very tempting. I've had my hand slapped myself by doing it, because it's a natural default position. Technology allows us to do that. So don't do it, is what we would say. And even I'm actually learning to do that now. So I don't do that. So I'd advocate that's not a good thing. But the reality is volatility looks like it's going to be with us for a little bit longer. Things have calmed down over the last sort of 6 weeks, but there will be some more bumpy roads to go on, certainly over the next 6 months. But it's a fact of life for investors. And something I saw the other day that I sort of would share with you is that we've had 16 recessions, 2 world wars, a Great Depression, a global pandemic, and goodness knows how many other events in the middle of all that, with certain crises and war and Brexit and all the rest of it. But the Standard & Poor 500 and its predecessor before it was called that have delivered on average a 10.5% annual return over the last 100 years. So in essence, what I would say is trust the process, trust your plan, trust what you've worked through with your advisor, and cut out all that interim noise. So sorry I've canted through it quickly, hopefully giving you a little bit of an insight. I'll hand you back to Katie, who will now sum up and cover some other important areas.
Thanks, Ian. So just before we go to questions, I've just got a list here of what we think are the good action points, particularly before the end of this tax year when it comes to capital gains tax relief, making sure that we use all our allowances if we can this year. If we can make sure that our partners and spouses have also done that as well, I think that gives us a huge advantage over what is to come in the next few years. Also, the inheritance tax exemptions as a way of trying to slow down the increase in an estate value, making sure that we're using our annual exemption allowance, which is gifting 3,600 away a year each, using gifts out of regular income that don't reduce our standard of living, the small gifts rules, etc. Whatever we can do to just slow down the increase in the value of the estate, I think needs to be considered. Also thinking about some of those other tax planning wrappers, can we include them in the portfolio just to give us a bit more tax planning diversity? And thinking about whether multi-asset funds have a place in the portfolio, particularly if there's a threat of capital gains tax in the future. And of course, you wouldn't expect me to say anything else, but regular reviews become even more important now. just checking what's happening as far as the inheritance tax liability and capital gains tax liabilities through the year is obviously extremely important. Thank you very much for listening to us. And if you've got any questions, please fire away.
Katie, I'll ask a question. It's something I think it's important. Is what's the sense of urgency around this now coming up in terms of certainly the capital gains tax changes? Should people be doing, you know, this? It needs some of the things need to happen like now. Is that right?
Yes, I think making sure that capital gains tax relief within a share portfolio or unit trust portfolio has been properly used, as far as, you know, to the £12,300 relief, and effective rebalancing done. Those are the most important things, I would say.
You've got to do that this year, this tax year, to get the max, because you're going to lose it then.
Yeah, and it's difficult because we've got a very short time frame from here. So, you know, if it was actually I've got second, third, fourth investment properties and I need to sell one quickly, that's not going to happen, is it? So, you know, the autumn budget didn't really leave us very much time to make changes to use the higher relief before it's going to reduce considerably from 5th of April.
Katie, you raised an interesting point about regular income being given away.
Yes.
I take it from what I've read, as long as you can prove that it doesn't materially affect the income and the life standard of the giver, the amount that can be given away on a regular basis can be as high as you like, really, as long as it's not, you know, as I say, affecting the lifestyle. Is it beneficial to keep, shall we say, a couple of years of bank records just in case HMRC decide to do some digging at a later stage?
Thanks, Carl. That's a really good question. Yeah, so it's the gifts out of regular income that don't reduce my standard of living. That's the exemption. And it's important just to clarify income there, because it's not investment income. It's earned income or pension income that comes into that income equation. But yes, you can give as much away as is feasible, as long as it qualifies. We always suggest that you document it, and the way that we recommend clients document it is to write a letter to the recipient. You don't actually have to give it to them, but you actually write it and hold it on file, and certainly it's worthwhile keeping a record of having made those gifts. But you know, there was a case a few years ago where father gifted son £40,000 to go into his pension, the son's pension, and the intention was that was going to be on an annual basis. And father died having made one gift to the son, and the revenue wanted to include that £40,000 in father's estate. But because father had actually set up a direct debit, they were able to prove that it was a regular commitment. So, you know, we've got some suggested words, Carl, that we can pass to you, but it's, you know, my intention is to give this to you out of my disposable income. It doesn't reduce my standard of living, and I'm going to do it, you know, for as long as I feel is appropriate. I reserve the right to stop it at any time.
Thank you. I've got the letters already covered. It's been running for a couple of years already. The difficulty comes where the amounts that go into the donor's account comes from two sources. Let's say dividends from stock and pension, whether it be the state pension or whether it be a company pension. And so you presumably have to show that that total amount is still feasible. So you can show that it's really come from pensions amounts.
Yeah, absolutely, Carl. You know, this is the nitty-gritty detail here, and could be a grey area when it comes to sifting through the information at the probate stage. And so to make everything as clear as possible is a huge help. You need to demonstrate that it's effectively coming out of pension income and not savings income.
Absolutely. And so final question, do HMRC, as a matter of course, investigate every single death for this, or do they pick 1 in 10,000?
Oh, Carl, the probate, the probate process can be long and very convoluted. And so, it is the executors or their representatives' responsibility to do everything they can to deliver the accurate information. And HMRC will review, I think it's 1 in 3 estates. And so I wouldn't mess around. From my experience, and we have a probate arm of legacy protection, obviously, we just have to be pedantic about this.
Okay, thank you.
Carl, from very personal experiences, quite relatively recently, I went through probate, and I engaged a solicitor to do it for me, and they were all over it. The HMRC never actually investigated it because there wasn't any IHT payable, but the solicitor was at pains to every single bit of money that went out of that account and where it went to. So yeah, it was good that it was done so thoroughly, but it is thorough. But the revenue never actually investigated, or never looked at my estate. But I can say it was painful, Carl. It was not easy.
No, I regularly every 6 months downloads 3 years back bank transactions. So I can prove what's there.
Well, I think you're probably more diligent, Carl, than many people then. So, carry on. That's really good. And, we've seen situations just in the last few weeks, haven't we, Tracy, where, the solicitors make big mistakes as well. So, do everything you can just to keep a record of it.
Thank you.
Good. Lovely. Well, thank you very much for joining us, and thank you for letting us record it, because it's going to go out to a few clients after this. And look forward to catching up with you in due course.
Thanks very much.
Thanks, everybody.
Thank you.